Thinking about buying stocks under $10 often feels like standing at the edge of a secret doorway, as if you've stumbled upon a hidden shortcut to wealth that most people somehow missed. And for many beginners, that feeling alone is intoxicating. There's a quiet excitement in believing that with just a small amount of money, you might uncover the next big winner, something that could change everything. But the truth is far more complex and far less forgiving than it appears at first glance. When you see a stock priced at $5, your mind naturally whispers that it's cheap, accessible, and safer because you can own more shares. And that sense of control feels comforting, especially when you're new and uncertain. Yet this belief is one of the most dangerous illusions in investing, and it's exactly why so many people begin their journey filled with hope, only to end it feeling confused, disappointed, or even betrayed by the market. The reality is that a stock's price is just a number on a screen, stripped of context, emotionless on its own, reflecting nothing more than a company's market value divided by its total shares outstanding, and it tells you almost nothing about the real story happening underneath. A low price does not mean low risk, and it certainly does not mean opportunity. Yet beginners often cling to it because it feels manageable, because it feels like a small bet, even when the consequences can be emotionally overwhelming. Many stocks under $10 belong to small or struggling companies, businesses fighting to survive or still searching for a stable identity. And these stocks often move violently, rising and falling without warning. For someone just starting out, those sudden drops don't feel like numbers changing. They feel personal, like failure, like proof that you made the wrong choice. And that emotional shock can shake confidence faster than any financial loss. There's also a quieter danger that rarely gets talked about: liquidity. And beginners usually discover it the hard way. Cheap stocks often don't trade heavily, which means getting in might feel easy, but getting out can feel impossible. And watching a position sink while you wait for buyers creates a helplessness that no chart can prepare you for. At the same time, the psychological comfort of a low purchase price keeps pulling people in, convincing them they're being smart, even disciplined, when in reality, they may be ignoring serious warning signs. A stock can be under $10 because the company is drowning in debt, bleeding cash, losing relevance, or failing to compete. And none of those problems disappear just because the share price looks small. What truly fuels the attraction to low-priced stocks is emotion, the excitement of possibility, the fear of missing out, and the constant noise of headlines, social media posts, and videos promising that a tiny stock could explode overnight. Those stories are powerful because they speak to hope, to the desire for fast progress, to the idea that you don't have to wait years to see results. But chasing that feeling often leads to rushed decisions and painful lessons. Sustainable investing, however, rarely feels exciting in the beginning because real value is found through patience, research, and an understanding of fundamentals like revenue growth, profitability, competitive advantages, and the people running the business, all of which matter infinitely more than whether a stock fits under a $10 limit. History quietly proves this again and again. Countless low-priced stocks have captured attention and enthusiasm, only to collapse and disappear, while strong, higher-quality companies steadily compounded wealth in the background, rewarding those who stayed calm, focused, and disciplined. One of the most important emotional shifts a beginner must make is realizing that investing is not about collecting cheap shares. It's about owning pieces of real businesses. And a $5 stock tied to a weak company can be far more dangerous than a $50 stock backed by strong fundamentals and a proven model. Learning this early protects not just your money, but your mindset, because confidence lost is much harder to rebuild than capital. Emotions are the silent force behind most beginner mistakes, and low-price stocks trigger them intensely. Excitement when prices jump, panic when they fall, and regret when reality sets in. Successful investing requires learning to step back, to evaluate risk calmly, and to resist the urge to act on impulse, even when the temptation feels overwhelming. That's why for many beginners, starting with diversified investments like ETFs or index funds can be a gentler introduction, allowing them to experience market growth, volatility, and emotional discipline without the crushing pressure of betting on fragile individual stocks. The promise of quick wins and hidden bargains is seductive, but it often distracts from the deeper truth that investing rewards those who value education, patience, and perspective. When beginners understand that low price does not equal value, they begin to see the market more clearly, not as a casino or a shortcut, but as a system that rewards thoughtful decisions over time. Social media and hype will always try to pull attention toward cheap stocks, creating temporary excitement and false urgency. But those waves fade quickly, often leaving behind losses and self-doubt. By focusing instead on quality, diversification, and time in the market, beginners give themselves space to learn, to grow, and to make mistakes without being destroyed by them. In the end, seeing a stock under $10 should spark curiosity, but also caution, prompting deeper questions about why it's priced that way, what the company's future looks like, and whether it truly fits into a strategy built for learning and long-term growth rather than emotional speculation. The most important lesson for anyone new to investing is that numbers alone are meaningless without understanding, context, and strategy, and that approaching low-priced stocks with curiosity, balanced by caution, can shape a stronger, wiser investor. Those who learn this lesson early don't just protect their portfolios, they build the mindset required for a steady, confident, and ultimately rewarding journey in the stock market.